Hi guys, welcome back to the channel. My name is Dave, and today I want to talk about equal weight ETFs with a big emphasis on ROE, which comes to us from Astoria Portfolio Advisors. Now, this is an interesting ETF that equal weights 100 different stocks. And why would I be interested in this? Well, let's put up a chart here. This is a 25-year chart of the S&P 500 versus the equal weight S&P 500. So market cap versus equal weight. So think RSP for equal weight versus VOO, IVV, or SPY, the one that everybody talks about all the time. They love and adore it. Well, look, the simple fact of equal weighting a portfolio like this gives us outperformance. So if we can combine that with what Astoria is doing here, which is to bring a quantitative and systematic approach to an ETF build, we might have something pretty darn interesting. So if that is what you're looking for, please stick around. Boop. So first of all, let's get our bearings straight. Astoria Portfolio Advisors is typically acting as a sub-advisor or working with RIAs to build portfolios. But they also saw a need to create some ETFs for retail investors like you and I. They thought they could create something very attractive. And out came ROE, which is their most popular ETF. So this is the Astoria US Equal Weight Quality Kings ETF. So it's 100 stocks, equal weighted, based upon their process of selection to narrow it down to 100 stocks. So that's ROE, and we'll talk more about it. But first, let's understand what equal weight really means. So for that, let's talk about RSP, which is the S&P 500 equal weight ETF. It's quite popular. So typically, people like to go shout about buying VOO, IVV, SPY, for example, and that is market cap weighted, right? So the amount of each stock in there is driven by the market cap of those 500 stocks in the S&P 500. So if we put the top 10 up here in the S&P 500 right now, right, we're going to look at VOO, for example. The top 10 constitute about 35% of those 500 stocks. That means that they hold a lot of weight, right? So the equal weight process that you're going to find in RSP, and by the way, I've reviewed it before. I'll link it up above. You can go watch a video on that if you want a little bit more information. But this process simply takes 1 divided by 500 and buys that much Microsoft. Then it takes 1 divided by 500 and buys that much NVDA. And it builds out the portfolio this way at the beginning of the year based on the constituents of the S&P 500. Now, each quarter, it's going to go back and rebalance that. So whatever performs really well in Q1, great, that's fine. If there's some poor performance, that's okay, because at the end of that quarter, we're going to rebalance that whole portfolio back to 1 divided by 500. And this process continues. And what's so fascinating about this is, like this chart shows that we already talked about, this process, while pretty simple, shows outperformance over a 25-year period. That's pretty impressive. Now, at this point, there's probably several of you out there wagging your finger at the screen saying, no, Dave, all the contribution, all of our return has come from the Mag 7 and those large cap stocks, the very tip top of the S&P 500 over the last 5 to 10 years. I'd say, yes, that's true. You can definitely see that separation over the last 5 to 10 years. But will that continue? So right now, we're looking at the top 10 comprising about 35% of the full index. That's quite a concentration versus something as simple as RSP where it would just be 2%, right? That's a big difference between just these two products. So where would you want to put your money now? Well, you want to find the best quality that you can find out there right now. And that's kind of what ROE is about. And when we start digging into this, you'll kind of see their strategy behind this and picking these stocks. But as interest rates are cut, as the rates come down, we're going to start seeing a bigger contribution from small cap and probably from mid cap because they're going to have the biggest benefit from those rate changes. Whereas large cap, I mean, what was the stat I saw with Google last quarter? I think that they made $1 billion off the cash that they had sitting on the sidelines. Well, that's going to go down a little bit. Doesn't mean Google is still not a great company, but there's definitely a concentration in some of these. So we need to find a way to strip out some of these that might be overvalued at this point and maybe constitute or put together something here that would work a little bit better for us. So let's take a quick look at ROE on the Astoria website before we start breaking down this ETF. First of all, this is a growth ETF. It will pay a quarterly dividend, but it's only going to be around 1.2% annually. So in line with where the S&P 500 ETFs sit right now. But this ETF is focused on capital appreciation. So it is not an income ETF, which I know we often talk about, but I like having these growth components within my own personal portfolio. Now, it is actively managed, and through its selection criteria, it picks a combination of 100 large and mid-cap stocks. And it's going to take all of those stocks, those 100, and it's going to set them to each 1% for each and every one of them at the start of each quarter. Now, I'm a big proponent of simple index investing. Index investing certainly has a proven track record, but I think that, as we go through this review, the argument for an equal weight ETF designed like this might make sense. So following this review, take a minute and check out the Astoria website. And if you think this is a good option for you, you can toss it in your portfolio. Now, RSP is probably the most well-known and popular equal weight ETF that is on the market, but we do have some others. One that I do own that I have a few shares of is EQWL. This is the Invesco S&P 100 equal weight ETF, and it's going to take the S&P 100 and it's going to equal weight it just like RSP on a quarterly basis. So in this case, 100 stocks, so 1% of each one. And it will reconstitute on an annual basis as well. And I bring this one up not only because I own it, but because it takes us a step closer to ROE. So with ROE, you're going to have 100 stocks. But in this case, their selection process is going to not just be basic. It's not going to be based upon, hey, you're in the S&P 100. Let's add you to the portfolio. Instead, they're going to use a systematic approach. So with ROE from Astoria, we're going to use a quantitative and systematic approach like you see here to select securities for the fund and to narrow the field from 10,000 wannabes to 100 stocks, which are equally weighted on a quarterly basis. And this process is repeated annually as well. Now, this slide shows you a little bit more about the screening and ranking process for the 100 stocks that are picked to be in ROE. This is also a pretty good time to remind you that Astoria Portfolio Advisors, one of their core functions is to build out portfolios for investment advisors. So it's going to be a pretty robust process here. So you can stop and pause and give this a good read through. But stocks are picked in all 11 sectors and they're based upon their established metrics. Stocks are then ranked using their quantitative screens, and they're going to look at things such as, for example, growth metrics, dividend potential, valuation, and overall quality. Then once they're picked, they diversify away risk by equally weighing all the stocks that are within the ETF. So based upon all that criteria, what's actually in ROE at the moment? Well, I downloaded all the holdings, and that's what you see right here. So at the very top, we see Vistra Corp, a stock that I've never owned myself, but now it sits at 1.1% of net assets. We know it started off as 1%, so it's up about 10%. I'm glad we own that one in this ETF. It's doing quite well. But I see several stocks that I recognize, and you probably do too, like Home Depot, Lowe's, Caterpillar, so forth and so on, AbbVie, Alphabet. So it does still contain the Mag 7 or some of the Mag 7 stocks, but it's based upon quality instead of just market cap. Pretty interesting, right? So Alphabet's up to 1.01. That's up about 1% since this quarter was rebalanced the last time. So scrolling down here, take your time, take a look. See what you see. Down here towards the bottom, it's kind of interesting, right? I see Microsoft. Now it represents 0.97. So it's lost 3% since it was rebalanced and put in this fund. But, if it was representing 7 or 8% of the S&P 500, that's a big significant bite, right? It's a bigger loss. So one of the reasons you can see the benefit of equal weighting a portfolio like this in this particular case. But that's just a quick rundown of the holdings. So now let's get into the meat of ROE and try to understand why this product is relevant at the moment and why it might make sense for our portfolio. Now, this presentation does come to us from Astoria Portfolio Advisors, but it has some very good charts here, and we'll breeze through them pretty quick. But I'll pick out the ones that I like. So in this case, we're looking at the S&P 600. We're looking at the trailing PE ratio of the S&P 600, which is the small cap, versus the S&P 100 large cap. And you can see this goes all the way back to 1973, and we've been oscillating between these points. So it brings up, are we at this inflection point? Has it occurred? Are we starting to return to the norm? In that case, small caps look like they could outperform going forward. Next slide. What do you think about this one? I find this one quite fascinating. So out of the S&P 900, we're talking about the combination of the S&P 500 plus the S&P 400, so mid cap and large cap. 12 companies are growing faster than NVDA. 37 are faster than Amazon. 62 are faster than Meta, and 155 are faster than Google. We're looking at earnings per share growth, ranking from 1 to 249. So these super mega cap stocks that make up a large portion of the market cap weighted S&P 500 index, well, maybe they're not pulling their weight, right? So we need to maybe look at the quality across all the stocks in here and have a selection criteria that makes sense. And that's kind of the argument here. But yeah, I really find this one quite fascinating. What do you think? Next slide. What do you think about this one that comes to us courtesy of JP Morgan? This is showing us that the top 10 stocks in the S&P 500 currently represent about 37% of the index, but they're only kicking in around 26.8% of its earnings currently. Let's go to the bottom left here, and let's look back here around 2016, where it was around, let's say around 17 or 18% was the weight of those top 10 stocks. And if you go over to the right, you can see that it was kind of 1-to-1, right? Right around 16 to 18% of the earnings contribution, 1-to-1. Fast forward to today, we're up to 37%, but it's only kicking in 26.8%. So again, do we have too much concentration in those top 10? Is there a better way to approach the stock market right now based upon what we are seeing? And should we be putting our dollars to work in a slightly different way? And I have one more slide here that I find interesting. In this case, the source is New Edge Wealth, courtesy of Astoria Portfolio Advisors. And we're looking at earnings growth. So going forward, we're looking forward in this case. Earnings growth is expected, I'll stress expected, to come from areas outside the Magnificent Seven in 2025. So again, Bloomberg consensus earnings per share growth by index. They're saying the Magnificent Seven index, 46% down to 20% as far as the earnings per share growth. While the Russell 1000 value will go from 3% to 12%. And the Russell 2000 from 3% to 36%, a huge jump. So forward looking, this could provide that double whammy, especially for something that's market cap weighted. So looking at something again like ROE that's looking at value across the index here and consolidating that into 100 stocks might be a good way to go. What do you think? So now let's jump over to Seeking Alpha and take a quick look at ROE. By the way, I am a Seeking Alpha affiliate. If you're looking for a stock and ETF research tool, this is kind of my go-to that I illustrate a lot on this channel. It's got a lot of great information and summarizes it nicely for you, so check it out. There are discounts down below. But ROE has an expense ratio of 0.49%. That's fair, I think. Equal weighted products tend to be a little bit more expensive, even for the very basic ones. In this case, we're putting a solid company behind it that's doing the stock selection for us. So 0.49% doesn't seem too terrible. Assets under management, 144 million. So it's been growing. Inception date was 8/1 of 23, so it hasn't been around for that long. There is analysis by one person down here, so if you are a member, you can check that out for a little bit more information. And just to give an idea of how it's performed over the first 430 days that it's been around, let's take a look at it compared to a few other products. So in this case, I'm looking at total return and I'm comparing ROE, which is about 24.78% over those 430 days, pretty good, compared to VOO, which has outperformed it slightly at 27.83. EQWL, that's the one that I mentioned, that's the S&P 100 that I do own, is up 24.32%. And RSP is trailing significantly at 18.14%. So that's what we're talking about, that outperformance, 27.8 to 18.14. Do all the charts that I show you convince you at all that, wow, we've really had a large separation here and that, well, maybe something to be concerned about if you're in all those large super mega caps? Something to consider. So yeah, that's the performance so far. So pretty good. It'll be interesting to see as time goes by how it performs. So maybe something to watch, something to buy. I'd be interested to hear your feedback on this particular ETF. So let me know what you think about ROE and if any of those charts convince you that this might be a decent option for you. I'm curious what you think. Leave me a comment, like, and subscribe. But it wasn't that long ago that NVDA was a mid-cap stock. If you go back about 10 years, it was right at the top end of being a mid-cap, right? The cap was about $10 billion. Since then, the market cap has increased up to about, it currently sits right around $3 trillion. Crazy, right? So you can see that explosive growth and trying to identify those at an earlier stage based on quality. Makes a lot of sense. So I sit here and I look at our current market conditions, and it does make me think, are we getting out ahead of ourselves a little bit with some of these large cap stocks? Is it time to look at something else like this particular product? Those charts, you look at those and they can be quite convincing. So let me know what you think. Now, something else for you to check out if you're interested in more content from me. Well, not really me, but a guy named Davis Watkins. He's got a YouTube channel, nice young man who started doing some podcasts. So I'm going to link my podcast with him down below if you want to go watch that. And if you do that, give him a like, give him a subscribe, and leave him a comment that Dave sent me, and give him a surprise. So go check that out if you're interested. But yeah, let me know what you think about ROE. I'd love to hear from you. Like and subscribe to this channel if you haven't already. And we'll see you next time. Have a great night.